Hi, and welcome to the Macro Show. We talk macro, trying to make sense of markets that really don't make any sense. I'm your host, Steven Van Metre, and thank you for all the great comments on Wednesday's video. I hope every one of you who was celebrating Thanksgiving had a wonderful Thanksgiving with your family. And man, have I got some interesting stuff for you. So some of the feedback was that I was totally wrong on gold and the market. I'll show you that in ahead of an insolvency event, gold does lead, and all it takes is looking at a few charts. How about hard evidence that the 30-year yield may go negative? No, it doesn't involve me putting the crown on, although I will. I'm just going to blow you away with some real hard evidence. And even those who think interest rates are going up, which is pretty much largely everybody in the market, will be wrong when there's massive evidence that yields are going down and people are betting against the wrong players. No, don't want to do that. Proof investors are all in. Got some economic data to look at. And the credit data, oh man, it's downright ugly. Ugly. Which is good though. Well, depends on how you're positioned in the market, right? From a macro perspective, it's great. Let's get into the data. There isn't a whole lot, obviously, because the data dump came out early due to the holiday and the markets closed early today, as probably most of you know. Let's take a look back from Thursday. Tokyo core CPI year over year, minus 0.3 to minus 0.7. That is more deflation coming out of Tokyo. How about their core CPI, excluding food and energy, also at minus 0.7 from minus 0.5. That's more deflation coming out of Tokyo in terms of, not coming out of Tokyo, in Tokyo, as consumer prices go down. Don't know what's with China industrial profit going up 28.2%. I don't know if that's a made-up number from China or there's something because of what was going on a year ago in October. Not 100% sure because I don't think that was when was Wuhan shut down then? Don't remember. Possibly. How about Bank of Japan core CPI year over year down minus 0.7%? Deflation in Japan. And people here in America say, well, all this, quantitative easing, Steve, and stimulus, that leads to high consumer prices. Really? Because Japan says it doesn't. How about Germany? The import price index year over year improved from minus 4.3 to minus 3.9. So they're still importing deflation in Germany. France preliminary CPI, the only place so far we're finding maybe inflation of 0.2% in France. And let's see, I think that's pretty much, Italian producer prices improved slightly from minus 3.1 to minus 2.5. So coming out of the factories in Italy, we still have deflation. All right, you know what? I meant to show you that chart on gold. Let's go and look at that before we get into the rest of the data. There we go. Okay, so this is a chart of GDX. We'll use gold miners. There's really no difference between that and gold, as many of you know. And so here you have back in 2008, right here, and you see the price of GDX, and we'll zoom in. This is a weekly chart, so we'll make this for fun, we'll do it as a daily chart. For those of you who think I'm cheating here somehow. So here's daily chart of GDX, and you have going into 2008, and then what we have July, it starts to fall off the cliff. Now let's overlay the S&P 500. So because what happens is during insolvency events or the lead into insolvency events, you see certain things happen that don't make a lot of sense. And somebody said, well, gold and all of these things are inverse. The stock market, really? Well, here's the stock market in purple. And I'll keep my mouse over so it shows up nice and bright. And what you can see is there are periods where the market rallies against gold mining stocks or gold headed lower. So you get this effect that this move down in gold is not a positive sign at this time. It's telling us perhaps we are entering an insolvency event. Now, we would look to the economic data to find that, and we'll do that momentarily. But I want to show you some really compelling evidence that interest rates on the 30-year may actually go negative. I mean, I know. Somebody said, well, Steve, that's just because you love bonds. I do love bonds, and it's because I'm the bond king. But that does not mean that I'm wrong. So let me show you some really hard evidence of this. It's going to blow you away. I'm surprised I didn't actually notice this sooner. Here we have the going back 6 months, the 30-year Treasury auction results. Now, keep in mind there is a competitive auction and a non-competitive. So non-competitive is people can bid and accept whatever the auction is, or there's a competitive. They can bid competitively, which most of the dealers do. Now, again, we'll look at who's bidding here. Primary dealers and direct bidders. So primary dealers, it says 6, are bidding for their house accounts, and non-dealers are bidding for their house accounts. So they're bidding for things that they want to sell to other people. Indirect bidders are going to be mostly pretty much your foreign central banks, foreign governments. Again, they're competitively bidding. They don't have to, but they're choosing to. So let's go up to the top and look at how to read this report, and then you'll see by the time we get to the current one what I'm talking about. So the high yield, the highest yield on this auction was 1.45%. Again, remember 6 months ago. And then you have the median yield at 1.838. And what does this mean? It means 50% of the auction was either sold at or below 1.38%. So that's pretty impressive. You can think 6 months ago, half of this auction was sold at a lower yield than now. There was demand. But even get this, the lowest yield, the low yield, which is 0.88%, meaning 5% of this auction, I'll show you, where is it? 5% of the amount accepted competitive tenders was tendered at or below that yield. So 5% was at, we'll just assume it was at 0.88%. So somebody 6 months ago bought 30-year U.S. Treasury below 1%. Now let's go to 5 months ago. And you see the median yield, 1.3%. We'll just round these numbers off. Same low yield. So again, 5 months ago, 5% of these offers, the 5% bid below 1% and won. That's how competitive they were. They were buying under 1%. Can you imagine that? Now let's move into 4 months ago. And what do we find there? Median yield 1.3. So again, half the auction went at or below 1.3 with the low yield at 1.15. So still lower than it is now, because where we're at now, just under 1.6. Keep that in mind. 3 months ago, the median yield 1.4. So half of this auction went at 1.4 or less. The low yield under 1% at 0.9. Remember, these are competitive bidding. This is one thing you have to really understand here. These are competitive bids. People are choosing to bid to win these awards or these auctions. That's important. Now, 2 months ago, the median yield, 1.5. Still lower than it is now. So far, you've seen 5 months of auctions where the dealers, keyword the dealers, the primary and non-primary dealers, bought half of the auction at a higher price, or the bonds are a higher price than they are now. And they're the dealers. And people think the dealers are wrong. The low yield was 1.45, so this was a lot closer. Now this is going to blow you away. Here's the auction that just happened, well, I shouldn't say just happened in November. The median yield was 1.6. No surprise, because the auction, the yields were higher then. So 50% of the auction went a little bit higher interest rate than it is now. But can you see this low yield? 0.0, I did not misspeak, 0.08%, meaning 5% of this auction was accepted at bids at 0.08% or less. Somebody was bidding zero yields on the 30-year. Oh, yes, my friends. Somebody thinks rates are going to zero on the 30-year. And you know what that means? Oh, we're loving that here in the bond kingdom. Boom, there's your evidence. Dealers are bidding at 0%. Sorry, I'm a little excited here. I'm going to put it back up. I know, I'm going to put it back up for you to see. Look at 0.08%. I'm not making it up. It tells you where the dealers think interest rates are going, to zero or lower. Maybe negative. How are they going to sell it? I mean, if you are a dealer and you're buying 30-year paper at 0.08%, that means the price is way above where it is now. For you to make a profit on that, what are you going to sell it for? At a yield less than 0.08%. Now, why would somebody, now, for all those people, all those pundits out there like, oh, yields can only go up. Why would a primary dealer or a non-primary dealer bank competitively bid at 0.08% and blatantly lose money? They're already upside down now. And if interest rates go up, they're going to lose a lot because they don't think interest rates are going up. Amazing what you can learn on this show, right? Glad you're here with me. Let's get into the other data we've got here, the H.8. And boy, when I saw this, I was like, whoa. Look at bank credit. Went up $12 billion. Pretty good. So we're seeing banks expand. This is what it's telling us. The banks are expanding their size. This is what you want normally. But the problem is how they're doing it. Securities and bank credit increased $49 billion, with mortgage-backed securities going up, check this out, $43 billion in a week. Keep this in mind. The securities and bank credit went up $49 billion. The Fed itself is only buying $40 billion a week. The banks bought more bonds than the Fed last week. More. Now, this is week ending November 18th, and this is, I want to show you when they did this. This is just crazy what's going on here. So let's zoom in to the 30-year Treasury yield, and I'll blow it up. Here's the week ending November 18th, which is the 20th. So here you have 1, 2, 3, 4, 5 days. Right here, the banks bought $49 billion worth of bonds. Not all the way up here, but after yields started coming down. And now people say, oh, this move up here, this is it, man. They're going to back up. Really? Because banks just bought $49 billion. And at the last auction, they bought some 30-year at pretty much 0%. How about mortgage? Let's see. Mortgage-backed securities up $43 billion. U.S. Treasuries up $21 billion. Man, talk about some hard trolling by the banks. Loans and leases, all commercial banks, down $37 billion. Commercial industrial loans, down $17.5 billion. You want to talk credit contraction? You know what leads, what happens, it causes insolvency events? Credit contraction, my friends. Residential real estate. Remember this hot real estate market that everyone now says we're under a new normal. One of my least favorite phrases, new normal. Everything's going to go up forever. Yeah, I'm sure it's going to. Down $12 billion. Remember, all this demand in real estate, and we're seeing the amount of credits continue to fall. Here's a baffling one. Commercial real estate up $3 billion. Why anyone would lend in that space, I have no clue. Consumer loans down $2 billion, with credit cards making up most of it. So even consumers aren't buying. This is crazy. Let's get over to the PowerPoints. I mean, is this stuff making sense? I mean, you're literally watching in real time how the economy is going to enter an insolvency event. Money supply, where are we? Here we are. 12-month rate of change continues to rise. Some people claim this is inflationary. Well, it doesn't quite work out that way anymore, does it? 6-month rate of change, 6.53 and rising. 3-month rate of change, 4%. Still, this thing is going up, up, and up. But let's look at the underlying data of the M2. And what do we find? Savings deposits are up a whole lot. Demand deposits are down. So checkable deposits down, savings deposits up. But institutional money funds down again. People, again, buying stocks at the peak. Now, we talk about, what's causing the dollar to go down. People are selling dollars. Well, how do I know? They're right here. This is institutional money fund. If you have money in cash, you have dollars. And if you sell those dollars to buy stocks, well, that puts downward pressure on the dollar. It's very clear that you can see that people continue to buy stocks at the peak. Wow. And that is pretty wild. Okay, let's get back to the charts. Real estate loan growth down to 1.81% from a year ago. This will probably be the first time we've actually had the year-over-year rate of change go negative in the middle of a recession. We've never had that, but at the rate it's going, that's going to happen. The 6-month rate of change is at minus 0.72. The 3-month rate of change is minus 0.66. Remember, we have housing crises when this thing just slows down, not let alone when it goes negative. Wow. This thing is not good. Bad. Commercial industrial loans down to 11.88% from a year ago. This thing's falling fast, though. 6-month rate of change is at 12.77. I mean, you're going to see this 12-month make a big move down here at some points. 3-month rate of change is at minus 6.3 or 6.4. Just hard contraction going on there. Loans and leases in bank credit, all commercial banks, down to 3.91% from a year ago. Normally, this is where we were before, but the 6-month rate change is at minus 4 and falling, telling us this thing is hardlining down. 3-month rate changes is pretty much at minus 2, and not even the consumer is back in the game. Credit card growth rates down to 10.7%. So you have no V-shaped recovery in the economy, at least from a consumer credit. You have massive contraction in the credit space going on, and yet people are like, oh no, the economy is in great shape, it's going to get better, the stock market's going to keep going up, real estate's going to go up forever, nothing is ever going to go down again. But yet in a debt-based economy where the expansion of credit is all that matters, it's rapidly contracting to the point where banks buying $49 billion worth of bonds in a week. Yeah, tells you who's on the right side of that trade. All right, let's get on to the last couple points. Proof that investors are all in, and these are kind of fun. Let's take a look at these charts real quick, and then we'll see what's going on in the bond market. We have the percent of S&P 500 stocks above their 200-day moving average. This is as of Wednesday, and I think someone posted this on FinTwit. It's even higher, obviously, now, 88.12%. This is very, very high, and when it gets this level, usually there's a big reversal. Look at the total put-call ratio of the S&P 500, smooth on the 5-day moving average, and what you see is the ratio of people that have puts to calls is very low, meaning investors are not hedging against any downside. And that's what we've seen in some of the other data, suggesting that when it gets to these levels, or even lower than these levels, as it did, that you're looking at a major reversal event coming. All right, let's take a look at what's going on. I wanted to look at this on Wednesday, but ran out of time with the super long episode. And I appreciate many of you who are still okay with that. Let's take a look at the bond market. Obviously, you look here at TLT, the last looking back to when the banks were buying, you have from this big green candle, 1, 2, 3, 4, 5. Here's that $49 billion purchase. So I wanted to look at what's going on here. And I've added these kind of orange dotted lines that you can see, or tan, whatever color you like. Because what happens here is we're in a consolidation pattern. And you can see that after I drew them in, that there was a bear trap, a second bear trap, and a big bear trap. And now we're up here. And I was kind of really hoping that it would bounce off of this, kind of validate where I drew the lines. And sure enough, an overnight trading, and then today we see it up. And what happens now is TLT is looking at breaking through the 50-day moving average, no different than we're looking at 30-year yields breaking back down through the 50-day moving average. And that's signaling a trend change. Now, we saw something similar. Let's zoom out to the yearly chart, and then we'll zoom back in. We saw a similar consolidation happening the last time before prices broke out, and you can see it was going sideways between these two, tan or orange lines. Bear trap came back, bear trap came back, and then bounced off of that, broke through the upside, went through a little consolidation zone, and away it went. We're seeing the same thing, so it'd be really cool at this point to see if we get a crossover the 50-day, and then a breakthrough this upper line, and then you start to really flush out the short interest, a break over, say, 170, 172, and now you're off to the races with everything else coming apart. We can't end a show without perhaps looking at the dollar, still trading almost right at its prior low here back on April 1st. Not April 1st. How about September 1st? If we go back, we're still, I'm still bullish on the dollar, even if it goes a little lower. But, everyone says, oh, it's headed way down here in the 88. Maybe. But the other side is it's got some latitude to get a little bit lower than its current point and still be A-okay. I'm still bullish on the dollar, and we'll take a look at gold mining stocks. Again, under their 200-day moving average. This is not a pretty trend, especially, again, if this plays outright and we still see gold mining stocks fall or even gold fall from a macro perspective, that tells us where equity prices are headed. You look at the contraction in credit, and it really kind of, gets you to believe that we are on the cusp of a massive insolvency event that the markets just aren't pricing in. Investors don't even think it's going to happen. I appreciate all of you who like my videos and subscribe and are loyal fans. It means a lot to me. I'm glad you're here with me. And we'll be back on the macro show on Monday, of course, and then on Sunday for the chart show. I'm Steven Van Metre. Thanks for watching. Thanks for being a fan. I'll see you then. Bye now. The content of this video is provided as education and information only. Is not intended to provide investor or other advice. It is not to be construed as a recommendation or solicitation to buy or sell any security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that I do not reflect the view of Atlas Financial Inc. or Steven Van Metre Financial.